Should you invest in mining companies? It's a pretty common question now that commodities have gained some steam recently, although there has been a bit of a pullback. It seems like a great idea on the surface, as there are large supply deficits for many of these commodities, even with an ongoing recession. But in this video, we're going to go through some of the reasons why investing in mining companies is probably not the best financial decision. But of course, nothing in this video is ultimately financial advice, and the decision is in your hands. But we'll start with the reasons why mining companies have horrible business models. We're going to go through 4 primary points as to why these companies are so bad, and we'll run through the typical results of your average mining investment. So the first and one of the primary reasons why the mining sector is so difficult to invest in is because of how capital intensive these businesses are by nature. The only pits most of these companies end up digging are the ones they throw your money into. Mining companies consistently burn cash with little to show for it, spending on drill rigs, survey equipment, excavators, haul trucks, and so on. And the usage of a lot of this equipment is assuming the company you own is even close to actually building a mine. Many times they're not. They spend tens of millions, if not more than that, just to see if they have an economic resource at all. And then, even after that, just maintaining operations is costly within itself. But the company still has to explore for additional resources as well. So even if a mine starts producing, most of the time, profit margins are extremely low or even negative. But just to illustrate how unlikely it is that a new project ultimately becomes a mine, only 1 out of 3,000 potential projects actually hits that milestone, according to Rick Rule. So you're entering an industry where the odds are already dramatically stacked against you. It is so rare to see a company actually make it to production and actually generate revenues that you essentially have to rely on the greater fool theory, where you hope that there's a greater fool that's ready to pay even more for an already overpriced stock. But next up is cyclicality, as for the second reason. And mining companies are the very definition of cyclical companies, because the prices of their products that they sell are entirely determined by market demand, which can vary wildly based on the overall health of the economy. If you're going to make much money on a mining stock, it will likely have to be extremely well-timed and in a bull market. Anyone trying to go into a mining stock to hold it for the long term is in for a rough time. These stocks are meant to be traded and not held. And even in macroeconomic cycles, there are more cycles within the lifespan of a mining business itself, visualized by the Lassonde curve, where the value of a mining company goes up during the discovery and eventual production periods. Well, there's a long period between when the mine actually gets built. So the share price depreciates as hype dies down, and there's even more cycles to worry about because of that. Another reason why mining is a terrible industry to invest in is because of just how frequently scandalous practices occur. Incredibly often, you'll find companies that have been properly called lifestyle companies, meaning the management team takes generous salaries, far more than they would ever need, insane stock compensation packages, and luxurious travel schedules. And mining is one of the worst industries for finding quality management teams. The vast majority are there just to try to sell a project that has no hopes of ever becoming a mine, issuing millions of cheap shares of themselves when the company was founded, fleecing retail investors even if that wasn't their direct intention. And the last reason we're going to point out here is regulatory risks. At any moment in mining, your investment could ultimately go to zero. Any moment. Doesn't matter if you're in the first or third world nations. In fact, some jurisdictions in the first world are actually the worst on the planet to try to get a mine permitted. For example, Spain ranks as one of the worst in the world, with Zimbabwe and the Democratic Republic of the Congo. So it's not as cut and dry as first or third world nations either. Being at the whim of governments on whether or not your investment ultimately succeeds in an already difficult industry is a really tough environment to try to invest in. And even in jurisdictions that are traditionally open to mining as well, you can still see this happen. Not long ago, one of the largest undeveloped projects in the world, the Pebble Project, was subsequently blocked by the Biden administration. And there are even more risks than those 4, but you get the idea. These companies are awful to invest in. And I would know because I've been through it. I've seen what happens. These are the stock charts that you're typically hoping for in a mining investment. And these are what you get 95% of the time. This is what the typical stock chart looks like. After hearing all these reasons why mining companies are such poor investments, you may or may not be wondering, why would someone ever invest in this sector? Well, it's for the same reason myself and countless other retail investors have at one point or another: the elusive, quick 100 baggers. Like I said earlier, 1 out of 3,000 of these projects ever actually becomes a mine. But if you buy into an exploration or producing company at the right time, the results can be truly extraordinary. And that's the pull of the mining sector. People hear of investors like Rick Rule, who bought Paladin Energy in 1998 at 1 cent and then had it fly up to around $8 per share when he sold out in a massive bull run, 800 times his money. People hear stories like that and they try to emulate them, but few actually make it work. Investors like Rick Rule have certainly built fortunes, but for most retail investors, this is not how investing in mining companies typically goes. The sector has built some fortunes, but it's destroyed far more. Now, the issue here that arises for most people is something Warren Buffett desperately tries to avoid: investing in things that he doesn't understand. Most people investing in mining companies have no idea how to identify what the strip ratio of a project will be, the different types of rock that are most suitable to mine through, and etc., etc. They don't truly understand geology. And I know this because I was the exact same way when I was investing in the mining sector. I didn't truly know what I was doing, and I knew that damn well. So I tried to find the best management teams that I could, ones that had previous successes before or extensive experience in the industry, so that there was at least some more credibility to their claims, as well as having an emphasis on higher levels of insider ownership. Funnily enough, though, my best return, or best potential return anyway, came from a company that didn't even have insiders with a high percentage of ownership. It was a company called Helium 1. And this was one of the last mining stocks I ever owned. It was in the exploration space specifically. And this one pushed me over the edge to actually look into better companies to invest in that had better business models. So what happened to Helium 1? Well, helium is incredibly rare to find in economic quantities on its own. In 2016, researchers at Oxford University, among others, found significant potential for economic quantities of helium in Tanzania. Helium 1 ended up acquiring the rights to a large percentage of this system, sporting helium concentrations near the surface greater than 10%. Putting this in perspective, 1 to 2% is already a high percentage, so 10% is nearly unheard of. An independent study by SRK found that their median estimate of Helium 1's Rockwell project alone was 138 billion cubic feet. And this was pretty insane because the total demand in the helium market per year is 6 billion cubic feet, around there. So Helium 1 could supply the world's helium needs for 15 to 20 years if those estimates were accurate, and that's just from Rockwell alone. I bought into the company the day it listed at 4 pence, and in the span of 6 months, the stock had run up to 20 pence because the company was drilling its first well. Well, guess what happened next? I didn't take any profits because I was insanely bullish, sure that I was about to make so much money, and Helium 1 couldn't finish out its drilling program because the drill broke. The initial results did show some promise, but the market didn't care. The stock price fell to around 6 pence relatively quickly. Because I was buying on the way up, I didn't buy my whole position at 4 pence, by the way. I was down 50% overall. So I went from being up 5x on my original tranche to down 50% overall in the span of a few days. The company has still not drilled much since. They've got a new CEO, and they're trying to get another drill rig right now to try to drill again. So, maybe they confirmed that they found helium this time. I don't know. But ultimately, this is how the story goes nearly every time in mining, especially in exploration. Instead of the drill breaking, though, the company just typically never finds anything substantial. So my luck was even worse in that scenario. But I make this video in part because I see a lot of YouTubers in the microcap space making videos about mining companies, which is fine. They can make videos on whatever they wish. But I want to point out the risks associated with this space. It's rare for people to make a substantial profit here. And I know that when I was posting about Helium 1 online back in the day on Twitter, it was exposing people to the story. Now, I know some people who bought in, at least partially, because I ultimately mentioned the stock. Now, I won't go through all the stocks that went wrong. It would be a very long video. And I'm not going to act like every stock was a loss either. I did have some stocks that doubled or tripled in a pretty short time. But my point is this. Yeah, as content creators, it's not our genuine responsibility to make sure people are making sound financial decisions. Yeah, we're not investment advisors by any means, and it is ultimately in the hands of our listeners to understand the risk brought on by any investment in a company that we discuss. But I also believe that it's our moral duty to make sure our audience understands the risks, that you properly understand just how toxic the mining industry is. And ultimately, content creators need to choose carefully what companies they talk about, because introducing an audience to that company could have an impact on someone's financial future, and it's probably going to be negative in the mining space. So, yeah, even if the content creator is not ultimately liable for this. Now, I don't like hearing about someone that follows me losing money, especially if they learned about the stock through my content. So instead, I choose to talk about companies that I think have good business models, that have a genuine possibility of turning a profit, and that could lead to substantial gains. And if I think the company that I'm discussing does not offer that possibility, or it's risky in nature, I try to say that openly in the video. And that's what I'll continue to talk about and be open about on this channel. But yeah, that's about it. And thanks for watching.